Hello guys and welcome back to another portfolio update. Today I'll be jumping into my £48,000 portfolio that I hold on Trading 212 in my stocks and shares ISA. I hold just 9 individual holdings that I believe are monopolistic or have a distinct advantage over competition, additionally having fast growing predictable free cash flows. We'll be looking at the overall return after this Trump rally we've been seeing in my portfolio, including the dividends received. I'll then discuss my buys and sells so far this month. I trimmed one of my successful positions for over £700 profit, so I'm keen to share that with you guys. We can then look through my individual positions and see which ones are my biggest winners and which, if any, are a lot of my losers. And finally, coming to maybe a summary, we'll talk through my overall weighting, what positions I want to add to, and sort of opportunities I see in the market right now. And if you get something out of this video, then please feel free to leave a like and maybe consider subscribing to the channel. So to kick it off, I have my overall value of this portfolio for the invested part of the portfolio sitting at £48,842 now, with a total invested amount of £40,339 and an unrealised return that we haven't sold yet of £8,502 or around 21%. Now we can see over the space of about 3 months this portfolio has done very well. We've gone from 30th of August sitting at about 4% return all the way up to around about 21% right now. And a lot of that has come from just this last month. We're actually up quite a bit on the market index. The market index being the S&P 500 being up around 2% or so, and our portfolio being up around 8.6%. Obviously, we invest in just individual stocks, no ETFs, and it's quite nice to get a massive jump, and I think the Trump effect had a big effect on that. Although it should be noted, I'm still losing to the S&P 500 over the past year or so. And that's mainly due to the fact that we can see over the past year, we didn't have a lot of money in this portfolio. We added a lot around April time. So April 2024, we added a hell of a lot of money. It went from about £6,700 or so. We've now added about 32k to this portfolio. So it's more than tripled in that time. So obviously it's going to be a bit up and down. There's not always definitive growth we're seeing in the portfolio, but we are up considerably with this bull market we are seeing from Trump being elected and a few other things. Now, it's interesting to note that if we look at the full return, not just the unrealised return, we're actually up quite a bit on this 21% return that we're seeing. So when we include the selling out of positions, so the realised gains, dividends received and then reinvested, and of course interest that we've occurred through our cash position, we actually get a return overall of around about 24% or around £9,973. And a lot of that has come from the sale of realised gains of over £1,000 that we see here. That's just selling out of positions that I didn't really want to hold anymore, or just taking gains from certain positions and trimming different positions. And we can see that I've got my free funds here as well. I've got about £1,853 held in cash on this account. That's receiving about a 5.17% interest rate through qualifying money market funds, and that's paid out daily. So I'm just letting it sit there. I'm not in a rush to spend this because I'm getting such a great interest rate, and I don't really see a need to necessarily add to positions that I think are overvalued right now. The market is very expensive, and I want to sort of safeguard my money until I see an opportunity. I'm not trying to time the market. I'm still invested heavily in the market. I just want to keep those free funds available because I'm not really seeing the same share price I was buying into with all of my stocks. Pretty much all of them are up considerably. So, and obviously we can see that my current tax year ISA allowance has been used up for the year, so my 20k has been used up. I can't add any more cash to this particular account until 2025 in April, so I'm just waiting, pooling my money together and getting a good interest rate elsewhere, and then I'm basically just going to put lots of money in, similar to how I did a bit before, but maybe not to the same extent. Now we could talk about my buys and sells within the portfolio. I only did one of each, and I wasn't really selling out of entire positions and buying into new ones. I was more trimming positions and adding to other positions within the portfolio. So it's more rebalancing if you ask me. But I did sell quite a bit of CRM or Salesforce. I trimmed them by about 33%, selling around 10 shares at a share price of $341 per share, for a gain of around about £719, getting a cash back around £2,679. Now that gave us some money to play with, and I added to another position. Now I want to be clear, it has very little to do with CRM. At the moment, I don't believe they're overvalued. I really like Salesforce as a company, but there is a few things that I have concerns about that aren't there with the company that I've added to. So I actually added to my Brookfield Corporation, and I added around 45 shares of around $58 per share for a value of around about £2,091. And we kept about £500 back and allocated that into our cash. But I actually added to BN over CRM because generally I just love BN's capital allocation and strategy for shareholders. When you look at the earnings calls for both companies, I have reservations with Salesforce particular CEO Mark Benioff. He feels like a salesperson. He's just trying to sell me a product. He's always trying to sell AI to me, and that has me concerned because I don't really like management teams that are like salespeople. I like them to be very upfront and to tell me how it is, and also be shareholder focused, which Brookfield Corporation is. So when I compare the two earnings calls, I hear a lot better things coming from Brookfield Corporation. They're just a lot more shareholder driven. They focus on opportunistically buying back shares, capital allocation in the correct areas and industries that are growing quite rapidly, and they have a more predictable line of growth if you ask me. So I wanted their allocation to be particularly higher. Yeah, so now we have Brookfield Corporation sitting at 16% in total overall weighting of invested stocks, and we have Salesforce sitting at about 11% weighting, which I actually prefer on the grand scheme of things. The main reason is just because I like Salesforce and I didn't want to lose it, but at the same time, I prefer the growth and probably the price right now for Brookfield Corporation, and it's actually a portfolio weighting sort of change rather than selling out of a position. So we can start off with individual holdings, and of course we've got to start with our highest conviction holding, the only one that's above 10k in the portfolio and the one with the highest weighting in the invested part of this portfolio, and that is of course Amazon. Now I've got 74 shares or thereabouts, sitting over a value of £11,659, and our overall unrealised gains on the position is about £1,037 in the green, by about 12 to 13%. This position I really liked. I really liked adding on this particular dip when it got below 180s, and I really liked the Amazon position as a main core holding. The reason mainly being there's lots of good things happening at Amazon right now. I'm seeing great growth within their cloud business. Their free cash flow is starting to really improve and pick up. Their operating cash flow and free cash flow is growing at amazing rates. So I'm seeing great things in profitability with Amazon, and I'm actually seeing the higher margined areas of the businesses that take less capital to run, like their cloud business, their advertisement business, they're all growing faster than their e-commerce business, which is of course low margined. So I really like Amazon as a core holding. I think it's going to do really well and probably outperform the market over the next 5 years. So that is why it's a core holding, and its weighting is now sitting at around 23 to 24% of this overall portfolio right now. And I quite like it sitting around 25% if I'm completely honest. And if we continue to see a dip and weakness that we're seeing here, I could see myself adding around the 180s. Now, I don't think we'll necessarily get there, but it could still happen. And next on the list, we have Visa, which is my second largest holding. We have 34 shares at around about £843 or so. We're up by about £1,300 on the position, or around 18.59%. And our cost per share is around about $263 per share. We were buying down here when it was around $260 mark for Visa, which I didn't think was that bad. I thought it was a fair value for Visa, if I'm honest. And obviously since that time, it's gone up quite a bit to now $310 per share. Now, Visa is a great dividend growth-based company. It now makes a weighting of around about 17% in the portfolio. I really like this company as a scalable business model. I think what they have achieved and the sort of returns they can give shareholders is really impressive. So I really like this company as a high weighting and main core holding. They actually got interviewed, both the CEO of Visa and MasterCard recently, in a sort of courtroom style debate with Congress. So they got pulled before Congress and asked about their business models and sort of grilled over credit card debt within the US and stuff like that, which I thought was quite funny because it sort of shows that Congress doesn't really know what these companies do and sort of how they make money. They have no interest made from debt positions that is obviously given out by banks. So I thought it was quite funny because basically they're just the credit card network, and because their little logo of Visa and MasterCard is on a credit card, even Congress sort of thinks, well, these are the people to blame them. No, it's the banks. The banks are the ones giving out the debt, and they're the ones that reap the rewards from the debt. So I thought it was quite harsh for them to get interviewed by Congress in such a way, but they sort of held their own. The MasterCard for CEO did really well. I thought she answered the questions really well as well. So bring it back to Visa. I really like the holding, and hopefully we can have MasterCard in the portfolio in the future. Next, in terms of size, we have Brookfield Corporation. Now I have 168 shares, an overall value of £7,800 or so, and we're up by about £1,333 on the position, or around 20%. Now this position's done very well over the past year. It's up 72%, and as we can see, on a bigger scheme of things, it was really undervalued in this sort of 2023 period, and I wish I was buying down here, but I didn't even know about the company then. And since that time, it's actually recovered very well, and it's now hitting the highs that it was hitting back in 2021 with the sort of market crash. What I will say is that my share price being around $49.50 is still not a bad share price in my opinion. Even though it's near that all-time high, I've actually been buying near these all-time highs because I still think the company's undervalued. I'm not really shying away from this all-time high with Brookfield because I do think there's massive undervaluation with the company. In terms of its allocation, as I said before, it's sitting at about 16% now, and I quite like that. I'd prefer it to sit around 20 to 25%, mainly because I've invested a lot of time, effort and energy into looking into this company, and I really like what I see. We've had some great super investors like Bill Ackman sort of buying into this portfolio, company, and I can sort of see the reasons why. Now, I did do a video on that, and there was sort of some good things that came out of it, and I did a bit of a deep dive into this company, so I won't get into it too much. But I really like the things Brookfield Corporation does, the opportunistic buying back of shares, the carried interest over the next 5 years looking very promising. There's lots of good things with this company that the market isn't necessarily pricing in, even though it's hitting all new highs. So I really like the company. I'll probably add more to this position into the future if it shows any sign of weakness. I really would prefer the share price to come down, but if there's no real other opportunities, this is the particular holding I want to bulk out, and I'd like to get this one above 10k, just next to Amazon. Then we have my fourth largest holding, which is Salesforce. I have now 20 shares. We did have 30, but now we've gone down to 20. And we've got about £5,489 in total overall value. And we're up by about £1,547, or around 39.24%. And this is a position that's done very well. Over the past year, it's up 55%, but we can see over the space of a month, it's up about 20%. So it's really gone on a great sort of run. And I was buying down here because I thought Salesforce was undervalued, and I wouldn't have sold anything down this sort of level really, because Salesforce was just massive opportunity at that sort of point. With the Salesforce sort of share price now coming up to $342 per share, and my share price currently sitting around an average of $248 per share, there's about a $100 difference now on my shares. And I think this run up is very good, but it's also done for the wrong reasons. I don't think people are really looking at the fundamentals and seeing undervaluation. I think they're hearing AI and then rushing to buy into this company. And when it reports its earnings soon and stuff like that, I think that if there's any sign that we don't mention AI enough and stuff like that, people will sell out of the position straight away because it only mentioned AI 3 times instead of 4 or something silly like that. So I don't think people are buying into it because they see the undervaluation with the fundamentals, which I still think look pretty good for this share price. It's literally just the case of that I could see some weakness with this one after it reports earnings if people are sort of buying into it for the wrong reasons. And now we can see, like we talked about before, its weighting is sitting at about 11%. It's currently now back up to the sort of levels, in fact, a little bit higher than when I sold it. But that doesn't really make me concerned. It will probably carry on a bit higher. It got past the threshold of me wanting to own more of this company, this sort of valuation, and I saw better opportunities with Brookfield than I do with Salesforce. But that's just my personal opinion. Now we have my 5th largest holding, Mercado Libre. We have 3 shares now at an overall value of £4,800, and we're in the green by about £850 or around 21%. Now this is a holding I actually added to quite recently. Effectively, it's an e-commerce style business with a fintech business that is growing quite rapidly in the background. And it's actually similar to Amazon in its scope, but they've gone a different way. Instead of going into cloud, they've gone into the fintech style business. And in their areas of operation, Mexico, Brazil, where they're really strong, and Argentina, I think this is a good play. We're talking about areas that have a distrust of local governments and local banks. And we can see that Mercado Libre and other big companies like Nu and other ones like that have done very well because they have actually undercut the big banks in the area of fintech. So I think that one shows great promise. The reason it had a bit of weakness around just after their earnings report was because they sacrificed short-term profits and EPS, which the market tends to hate all the time. But if you read in and dive into the earnings report, which I did, and obviously I showed when I bought about £1,000 more of this stock in my more recent videos, I actually said that this is a good thing for the company. It may not seem it right now, but the share price is already recovering, and that is because people are starting to realise maybe that growing quickly and sacrificing short-term profit is a good thing for management to do. They've grown their credit portfolio at 77% year over year. They have said that they couldn't do this without sacrificing short-term EPS effectively. And they had a few other things like shipping concerns and stuff like that, which held back profit margins. But e-commerce is not an exact science. There's lots of moving parts of it. It's low margined. And I think that any company that can grow its revenue over 30% and be the fastest growing in my portfolio deserves the weighting of this sort of high quality company. I didn't want this company to have more than 10% weighting in my portfolio, and I've said that throughout, mainly because the areas that they operate in are quite hard for me to follow. Their economies are quite complicated. They can have high levels of inflation like Argentina had just a couple of years ago, and they've now since started to recover from. So Melly now sits at 9.8% of the portfolio. I probably won't trim this position. There's no real read to. I still think it's fairly valued right now. And I did add on the dip after its earnings report. So we now have an average share price of $1,684 per share, and it's now sitting at over 2,000. And I think this one will continue to do well into the future because the fundamentals are improving so well. Next we have VICI, which is my highest dividend paying company and also my only real estate based trust. So we have 140 shares of VICI, and we have £3,574 in overall value in the position. We're up by about 9.5% or around £310. And this one will continue to do well as the interest rates continue to come down, because certain companies and obviously people in general are looking for a higher yield. Our cost basis now sits at $29.53, with the overall sort of share price sitting at $32. So people will want the dividend yield of 5.2%, because soon the interest rates in America and other places like the UK are coming down. And as they come down, people look for dividend yield elsewhere. And that's when dividend-based companies tend to do quite well. So I expect this one to do better in the future. It's actually underperformed the market quite a bit, and I've actually questioned why I owned it a few times. I would say out of all of my holdings, this is the particular company that I could see myself selling out of. My main reason is because I don't like real estate trusts. I don't like how they operate. VICI is, in the past, I've described as an exception, but it's not really in terms of how they operate. They're still a real estate trust. They still dilute your shareholder position by issuing shares to leverage capital against them. And that is how they operate. I'm not saying that they're not very successful when they do that. And VICI have grown their AFO per share very well. It's more about I want to compound my particular positions for years to come. And VICI is a position I could see stagnating over time, because simply your shares become less valuable over time, as with all real estate trusts. The higher dividend yield is very nice, but I'm not buying companies for solely their dividend yield because of my time frame. So if I was maybe an older investor and I wanted to maintain my dividend yield and maintain my value of my money, I would look to keep my money in VICI. I could see myself selling out of it if this one goes up to the sort of intrinsic value that I know it to be. It's sitting around $37 per share in intrinsic value, if you ask me. It's a company I really like. I love the high quality holdings that they have. I love their triple net leases. But all of this sort of leads me back to I don't really like real estate trusts. So we'll see how this one gets on in the future, but I could see it being cut from the portfolio in the next year or so. And its weighting now sits at around about 7.32% of the overall portfolio, which I don't really like. I think I would actually like it to sit about 5%, and then maybe not be there altogether, because I want to focus on growth and dividend growth. VICI does that, but I think there are better companies that maybe don't dilute my position as a shareholder like real estate trusts do. So we'll see how this one ends up looking in terms of weighting in the future. Next on the list, we have S&P Global, which I have just 7 shares of. Our value sits at £2,878 in overall weighting. We're up about 22% on the position, up by about £524. And this one I was buying in the low sort of $400 mark, about $419 is my overall sort of share price. And now it sits at about just $100 above that at $514 per share. S&P Global is one that is such a high quality holding. I really wish I had a higher allocation to it. It now sits at about 5.8%, which I just would really prefer to be higher and a main core holding in this portfolio. But with the recent run up in share price over the past year, it's up 26%. And in the past 3 months, it's sort of stagnated. And that's because, in my opinion, the value, the dividend, the cash flow yield you're getting at the moment is okay, but not amazing. So I'm looking for a weakness with this one, so I can maybe add to it and get a better weight in the portfolio. But I'm not adding at these current levels. Next, of course, we have our Texas Roadhouse position, which is probably our best performing company so far in our portfolio. We have 18.29 shares, an overall value of £2,800 or so, and about £1,097 of that has come from unrealised gains, now up about 64% on this particular position. This is a company that has done so well over the past year, up 73%, and we've actually been totally invested in it throughout that time. We was actually buying around this sort of dip in October 2023 when it was severely undervalued, under $100 per share. And then we sold it in our non-taxable account, our taxable account, and then put it into the ISA around this sort of dip in the 15th of January 2024. And this has probably been the best investment because Texas Roadhouse has actually come out of a period where people didn't think they would do necessarily well, with higher increasing costs in terms of meat and stuff like that. People thought they might struggle with opening up restaurants, and they just simply didn't. They kept on opening up new restaurants, they've kept growing, and their market cap has continued to be rewarded in going up. I'm not selling out of this position at all. I think it's slightly overvalued, but I don't think it's overvalued to the moon. And my main reason to keep it is because I still think this is a great holding to have for the future. I think it's probably going to outperform very well over the next 5 years. And it's already a very good return on my current money. So I'm not really looking to take away from this position. And it's now sitting at a weighting of around about 5.75%. So I actually quite like its sort of weight in the portfolio, and I'm going to keep it as it is and let it compound over time. Then we have my smallest position, probably a great holding that I should have more weighting to, and that is, of course, Google. I have 10 shares. That is over a value of £1,300 now, and we're up by about £180 or around 15% on the position. We actually bought this one fairly recently. We bought on around the 2nd of September when it was sitting just below $150 per share. And this is probably one of my best time buys to date at the moment. And I've just really liked buying into this position at such a low cost per share basis. We can see that I've got an average share price of $149 now, and the market price, even though it's actually shown considerable weakness quite recently, is now down to $165 per share. I'm really not worried about Google being broken up. I know that this is what's being touted a lot, and lots of news articles being made around it, and the asking by the US Justice Department to break up and sell Chrome. I just think it's pretty unlikely to happen, if I'm honest. It may do, but I really don't think Google is going to be broken up in that way. I think they're going to get a heavy fine. They're going to have to restrict what they do in terms of practices like the $20 billion that they give to Apple to keep Google as their main default search engine on Safari. Things like that will go away maybe. And I don't think that will be necessarily a terrible thing for Google. I think people will still automatically use Google because it's a verb, it's what people use, and it's where people go to find things. The next search engine after that, I think, is Bing, and Bing's always getting searched with Google or YouTube. So I think that the main things to consider with Google is to ignore the short-term sort of fluctuations. It's not really one that's doing very well in the market right now because everyone's talking about AI and Nvidia and stuff like that, and then all they hear is bad news from the US Justice Department about how Google's a terrible monopoly. I think that's ironic because there's lots of monopolies in America, and they seem to be going after a lot of them, but only certain ones that they're not really invested in, which I think is quite funny. So in terms of the share price right now, I think it trades at fairly good value right now. I think if you was looking to start a position with Google, now would be a fairly good time. Over the past year, it's up 22%, underperforming the market a little bit. And when we bought was just a very okay time to buy, and I probably could never do it again. So I will probably look to maybe add to this position. It's now sitting at a weighting of just around 2%, 3% even. And I would like that to be higher. I don't know how high for Google. I could see it maybe sitting closer to around about, just below 10% maybe. I don't want it as a core holding, but if it ended up being, I wouldn't be that distraught. It would have to give me the share price that I saw previously maybe. So I'd look to add to it below $160 or around that. But I'm not massively willing to just throw my money at it. It's gone down quite a bit recently. We'll see how it performs over the next couple of weeks. If it doesn't go below that share price, then I won't add to it. I don't know why I'm taking this approach with Google. I think it's a really high quality holding. It's just, I think I'm seeing better opportunities with the likes of Brookfield and stuff, and I don't know why, but me personally, I want to be involved in the companies that are in the background. They're boring companies that no one really talks about. No one ever really talks on the news about Brookfield because lots of people don't even understand what they do. So I quite like that. They're in the background. They're just compounding people's wealth and making shareholders very rich. So that's me. That's what I want to do. I don't want to be in the news every week about how my main holding is a monopoly and how the US Justice Department is going to tear it down. But Brookfield's growing rapidly. It's rewarding its shareholders, and even though you say, oh yeah, it's at a 52-week high and all this, I don't mind allocating resources to something like that and seeing short-term weakness in the portfolio if I'm going to see long-term gains and not really have to worry about my holdings. So I don't really worry about Google, but I'm not really keen on being in the news all the time with one of my larger holdings. So we'll see with Google. I will probably end up adding to it if it continues to show weakness that it recently has in the past week or so, being down close to about 5%. So that is about it, guys. These are all my holdings. Now we can see them all together. Obviously, some have done better than others. VICI's probably been my worst performing stock so far in this portfolio since April. And I think that's unfair towards the real estate trust because I do think they will perform well in 2025 because when the interest rates come down, people look for other places to allocate their money for a steady dividend yield and not really worry about growth like some of these other companies. We can see that lots of my holdings are based around dividend growth. If you take a look at it, we've got Visa, Brookfield Corporation, Salesforce, VICI, S&P Global, Texas Roadhouse and Google, all of which will probably be growing their dividend over 10% and probably closer to 15% into the future for the next 5 years or so. That's a very good thing in my opinion because my dividend yield is continue to rise, yield on cost is going to rise, and the share price is going to appreciate. And those are the sort of companies that tend to outperform the market in the long term, in my opinion. So when I look at companies that I've invested in that haven't got a dividend, they are ones that are going to do very well as well, in my opinion. You've got the likes of Amazon and Mercado Libre sort of being the main ones I'm talking about here. They don't pay a dividend, but they're growing very fast. Mercado Libre has over a 30% revenue growth year over year, and Amazon is massively increasing its free cash flow at the moment and operating cash flow. I think year over year, free cash flow increased by about 74% or something like that. So when I look at these companies and see how they're growing, they're all doing very well. I like my focused, concentrated portfolio weighting. It sort of means a lot to me that I see my portfolio just continue to build with time. And I want to see my holdings just gain in terms of size and not really gain lots of different holdings. I don't want to own any over 10 stocks if I can help it. And I'd prefer to sit closer to about, maybe 7 to 8. So that's going to be the aim going forward. I'm going to look to add to certain positions in the near future. But I am worried about the valuations I'm seeing in the market. I'm seeing a lot of euphoria. I'm seeing lots of things, people posting a lot about their returns within Palantir, within SoFi, within every company just seems to be doing very well right now. And that's not to slam these companies, but it is to say that I'm seeing a lot of greed in the market right now. And it's just what I'm seeing on Twitter, on YouTube even. I'm just seeing a lot of sort of great things in the market. And that has me a bit concerned that we might be on a bit of a cliff edge. So I can see a lot of overvaluation in the market. I'm seeing very few opportunities. There's a few companies that I like the look of right now in terms of valuation, but there only are a few. The likes of ASML, Uber, that's a good sort of price right now. Brookfield, I think, is still a good price despite the recent run-up. So when I look at companies, and Amazon is even coming down now below $200, I think is still a good buy for Amazon. I just think that there's not that many opportunities in the market. And whilst I can continue to be completely invested in the market, I have got some cash on hand that I just sort of keep there because I'm not seeing opportunities. If I see the opportunity, I will invest it and I will have no free cash. And if the market tanks, I will sit in the market. I'm quite happy with that. I'm not really one to try and time the market. I just don't see the opportunities in the market right now. All of my positions are up over 10%. In some cases, they're up to over 60%, and I'm not willing to add to those positions at these valuations. But that's just me. What do you guys think of this portfolio? Do you like it? Let me know down below. And as always, thanks for watching. I do appreciate it, and I'll catch you in the next one.